On the US economy and US government policy, a quick fact: the post pandemic inflation crisis we faced was in percentage majority attributable to the post restriction spike in global demand, and subsequently within the same inflationary cycle attributed to the Build Back Better Act, respectively 33 and 31%. So the hot topic is spending cuts by government, ordered by President Trump and executed by, in part, Elon Musk. So if you consider the Build Back Better Act spurred on inflation through government spending, the aforementioned spending cuts could have a sizable impact on inflation reduction. A key factor is important: 31% of the Build Back Better Act spending supporting inflation. The reverse in cuts is differently correlated to the outlook on inflation in 2025. Goldman Sachs indicates the potential spending cuts uh, will bring the final reading solely based on the spending cuts out of government, bring the final reading for 2025 to 2.4% inflation year over year, which is considered unfavorable by monetary policy makers. So that figure is 2.4% figure is purely estimated on the cuts in government spending. On the housing market, US existing home sales dropped steeply in January after 3 months of strong data. The drop was steeper than expected. The principal cause of the drop in January is caused by higher mortgage rates and high housing prices. A very interesting dynamic occurred within the 4 month period, accounted of existing home sales. Keeping in mind that mortgage rates were considered to be elevated and existing home prices have been high before the 4 month period, in which there was a 3 month plateau, and in the final month, the fourth month, the January month, existing home sales took a sharp downturn, more sharp than previously expected. Buyers have been discouraged eventually after the pocket of demand depleted, in which there were a number of buyers willing to carry the costs on aggregate higher, a higher cost on aggregate due to expensive mortgages and elevated home prices. That means there was a pocket of demand in the housing market. The demand was for existing homes, and that pocket of demand has disappeared. So the number of buyers in the market have executed on their intent to purchase a home and carry uh, the, the excess costs tied to the current environment, principally attributed to those aforementioned two factors. Another topic: India GDP. The final key takeaway we had on India GDP, if the stellar performance out of 2024 could be sustained. A technical note is from the May to July month, growth leveled off because global uncertainty affected the performance of the Indian economy. I want to make very clear to everyone in terms of the outlook, the period of growth being suppressed has not changed the secular outlook on the Indian economy uh, performing well or delivering growth. The issue is there was a downturn in consumption by households. The downturn in consumption by households was um, compen- compensated by government spending. The government spending is critical, so that is especially doing business with borrowers, the consumption that compensated the the expenditure by the government compensated for weak household consumption. Goldman Sachs indicated after the seasonal adjusted effects for the holiday season, a certain period by the end of the year, typical to India, demand remained sluggish. Goldman Sachs also want to emphasize on a policy level there is growth to be unlocked by policy based reform specifically oriented at the equality, economic equality, which is guaranteed. The cost of these executing these policy reforms towards, consumption equality eventually is guaranteed to bring about a tangible return, even in terms of a multiple, in terms of the initial cost.